Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial, investment, and retirement future. He is president and founder of Mcintire Retirement Services, serving Northwest Ohio savers and investors trying to navigate this difficult economy. Chris Mcintire here with us. And Chris, going to be talking today about interest rates and all of the aspects and facets and issues that rising interest rates impacts. And I'll have to admit that before the program and you sent over your information, I really didn't realize how many things interest rates really did impact.
Yeah, it is really amazing of what all is going on out in the economy right now with the rising interest rate. So I'm looking forward to today's show, Peter. We've got a lot of good information for folks. So hopefully they'll listen up, turn the radio up, and we'll get started.
Well, as we do get started, do want to remind you, ladies and gentlemen, that you have the ability to have a discussion and consultation, a sit-down individual review and strategy session with Chris Mcintire. If you would like to make sure that your plan is working in alignment with your goals, that you understand your investment and retirement accounts, give a call, 800-868-1194. That's 800-868-1194 to get your game plan for retirement put together or to get a better understanding of the plan that you have in place. 800-868-1194. That's 800-868-1194. So, Chris, market volatility is obviously the story of 2022, but one of the big reasons we are seeing that volatility is because the Federal Reserve has been on a track of continually raising interest rates. They have kind of a dual mandate. They are supposed to promote full employment and keep inflation under control. That cat sort of got out of the bag and out ahead of them. And so now we are trying to play a game of catch up somewhat in controlling these inflation rates, and interest rates are the tool and weapon that the Fed has.
Yeah, and that's probably a good way to describe it, a tool and a weapon. It can be a good weapon or a bad weapon, depending who they're aiming it at. And, part of this, the biggest reason for the rising interest rates is to, stop the rate of inflation from getting out of hand, and we obviously, if you've been to the grocery store, we certainly know what it's doing to people's purchasing power. So we've gone from historic low interest rates to all of a sudden some, radical changes in that interest rate environment. And, part of that's going to bleed down, into borrowing costs for homeowners, borrowing costs for, people that want to refinance debt, move their, and how it's going to impact on the real estate side of things is certainly a big concern. But, this all stems from overstimulating the economy. And, if politicians are going to take credit when things are good, they need to take the blame when things aren't so good. And they just simply added way too much money to the system, if you will. And people were flooded with cash. It was hard to find goods on the shelves or cars in the parking lot. Money was very cheap to borrow, so people could, move into that next neighborhood or skip a neighborhood for our realtors out there if you really wanted to upgrade your house. And now we're seeing the other side of that to try to control the rate of price increases or the rate of inflation, Peter.
And Chris, this has really been going on since about 2009. After the Great Recession, there was the effort of quantitative easing and several rounds of that where the Fed used another one of its weapons, the ability to buy or sell bonds, U.S. Treasury debt, and they were buying lots and lots of bonds, pumping trillions of dollars into the economy. They thought they were going to slow down, and they began raising interest rates in 2018. We saw the market react and they sort of held off on that. And then COVID hit. And so we had sort of a financial emergency and they started the machines back up and the printing presses, so to speak. It's done a little bit more digitally these days, I think, but pumping another $6 trillion out into the economy. And now they're trying to reel that back in. Is it too little, too late, or are we doing the right thing? What's your opinion? Because Jerome Powell says he doesn't mind, and he is aware that rising interest rates is going to cause pain for individuals and volatility in the market.
Yes. And if you want to think about things, the dollar right now is very strong worldwide against other currencies. And obviously the British pound has made some headlines here, with them trying to manipulate their currency values as well. So the dollar being very strong is just attracting more dollars into the dollar because we're trying to control our inflation rate here more aggressively than other countries are, like the United Kingdom. And obviously they have a new prime minister that came into play and, really threw the markets into upheaval. And that was there toward the end of September, which ended a horrific quarter, which is historically a very horrific quarter in the midterm presidential cycle as well. So some of that was not surprising because historically it happens. But as we're trying to get a control on inflation, are they going to slow the economy so bad or slow the pace of money? And that's what they're really trying to do, because the Federal Reserve is setting rates that banks borrow from each other for overnight loans to make sure the system's nice and liquid and whatnot. So the more borrowing costs that those banks have from one another, the less likely they're going to lend where they don't need to, take certain amounts of, back off their credit risk, if you will. And riskier borrowers are going to pay a lot more to borrow dollars and borrow money to buy a new house and whatnot. So are they going to say, you know what, we're just done with everything. We're only going to buy what we need, the consumer staples, if you will. And we want to keep our lights on, like utility companies have been, kind of a bright star or maybe the best dance partner in a bad musical, if you will, for this year. So it's been a lot of challenges, and there's going to be a lot of challenges going forward because, obviously, are we going to go into a recession? Are they going to slow things so bad, so fast, so sudden that everybody's going to say, you know what, I'm not going to buy anything else because I'm going to wait until prices come down. And all of a sudden we get this freeze, if you will, and the flow of money really slows down. Now, the good side of that is inflation's going to slow down. Prices are going to come down as well. But how sudden are they going to, and how many job losses will that equate to? Because let's face it, that's what it boils down to. When you go into a recession, people lose their livelihoods, and that's a tragedy for Americans.
We are having to navigate all of these factors as individuals, but if you would like the help and assistance of a qualified, experienced professional to look over your financial well-being, your planning, your investment and retirement portfolio, pick up the phone, give Chris Mcintire a call, 800-868-1194. That's 800-868-1194. We'll talk a little bit more about how the Fed is controlling and setting interest rates, how that does impact mortgages and home values, bonds and fixed incomes, savings, debts, the investments in the stock market, and pensions. And this is an important one. Maybe that does not impact a lot of people, but the people that it does impact, pretty significant impacts if you have a pension lump sum on the line. So stay tuned throughout the show. Lots of important information that we're going to be covering about what rising interest rates do impact. And again, if you've got a question, give Chris Mcintire a call, 800-868-1194. That's 800-868-1194. Now, Chris, banks aim to be profitable, right? They loan money out and try to make a rate of return themselves. So the Fed controls the rate that banks can borrow money at to then turn around and loan it out. They want to make a spread on that. The Fed has already increased interest rates 5 times, and banks are now paying 12 to 13 times higher rates than they were at the beginning of the year. So this is going to significantly slow the velocity of money and the lending that they do to basically finance the day-to-day lives and activities of corporations and individual Americans.
Yeah, no question about it, Peter. And again, for those that have the higher credit ratings or a bigger credit risk to a bank, they may not loan money to them at all, even, and not to take the risk, because obviously they have to protect the bank's assets and the shareholders in a lot of cases as well. So, there is if you look at the economic ladder, these things have an impact on the lowest part of that economic ladder, unfortunately. And it's just some of the laws of nature. Those people get hurt the most. They earn the least amount of money. They get charged the highest amount of interest. So, it's almost a self-fulfilling prophecy, I hate to say, Peter.
Well, and now the roofs over our head are less affordable, Chris, because of these higher interest rates. We will probably see a slowing, if not just a non-existent market for refinancing our current homes, because that was being done because we could get a lower and lower rate over the course of the past decade. And then people moving into bigger and bigger homes because they could afford to do so at the same payment is likely going to slow significantly. It's not that we'll stop moving, but we'll probably only be moving out of necessity or in have to cases moving into the future.
Yeah, it's a good point there. I was going to say it's not going to be, hey, we want a new house versus we have to have a new one because we're relocating or, job changes. You're absolutely right. Yeah, because if you run a mortgage calculator and you run a $500,000 house at a 2% interest rate, 2.5% interest rate, that's cheaper than a $350,000 house at 6.5%. So if you're currently in that $350,000 house at 2.5% or 3% in the low rates, you're not going to buy a $500,000 house at 6.5%. It's just going to, cost so much money. So we're probably going to see that market freeze. It'll go back to more of a buyer's market eventually, and we are hopeful on the other side of this, looking into 2023, probably the latter half of that into 2024, that, interest rates may actually start to come back down, even if they get inflation in check. But, a lot of geopolitical pieces at play here, of course, between Russia, Ukraine, how is the energy markets going to play out? Oil prices are, back up there, rather high, starting to work their way back up there kind of high now, with OPEC had been cutting energy production, and why we don't, as a country decided to become energy independent ourselves is, again, another part where if you're going to take credit, you have to take part of the blame, and gas at $4 a gallon doesn't help anybody.
Well, the Fed Chair Jerome Powell has stated that there will be several more sequential rate hikes. They are targeting a rate of around 4.4% is what he stated. So, Chris, some further increases from here. Well, that means that adjustable rate mortgage holders certainly need to watch out. Their rate and their payment amount could probably increase. And you talked about the buyers versus the sellers market. Chris, for the last several years, it has certainly been a seller's market. There has been a line of buyers as soon as the for sale sign goes up, willing to pay at or above asking price. But now we are starting to see that turn. I'm not sure if we can qualify this market as a buyer's or a seller's market, because the buyers now are having to pay those higher interest rates. So it's kind of this weird in between time. Also, renters have been impacted by this market, Chris, because there has been a lack of inventory, because there's been so much competition. Rent has gone up, and there's been a lack of inventory. Well, builders and developers finance a lot of their projects too. And so these rising interest rates are going to impact the ability for those builders and developers to build the new home inventory that we need.
Yeah, absolutely right. And for those that get priced out of the housing market, those first-time home buyers, for example, they're going to go into that rental market, and rents have obviously increased, substantially here over this course of the last, let's call it 24 months, basically. And that trend looks like it's going to continue as well, Peter, until, we get interest rates back down where, people are used to them. I remember the 70s and 15, 16% interest rates. A lot of folks, we were at a political event not too long ago, the both sides were talking, and they were saying, look, we're both young enough that we don't remember inflation. They're 35, 36 years old. And like, we don't remember inflation. This is something that's brand new to us, these types of cost increases. So you got a generation, the millennial generation that hasn't dealt with anything like this before, where my parents were right in the middle of their working careers back in the 70s. And they saw how inflation was when it got out of hand. Hopefully that the Fed is going to be able to, curb it and control it, because the other side of this is the United States is what, $28 trillion in debt, and 70% of that is owned by foreign governments. And, look at how much the interest rates going up are going to cost us to pay the interest on the debt. So, that's another impact. That just takes money away from highways and education and all of those, when what used to go into the economy is now going to our debt holders.
Yeah, indeed. And debt, another area that interest rates and rising rates do impact. Chris, I recently saw famed successful investor Warren Buffett talking about credit card rates and how if he can issue debt that people are paying 13 to 26% on, he doesn't really even believe he needs to take the risk of investing his money if that's what he can make in interest on debt. And for more and more of daily life in America, Chris, it has been about debt and financing. We put our daily purchases on credit cards. We finance our larger expenses. So these rising interest rates is going to have a significant impact on more of us who are even more in debt than ever before.
Yeah, no question about it. And, if the government follows what people need to do is pay down debt, okay, well, they may have to raise taxes to pay that debt down as well. A lot of us retirees and clients that we have by the hundreds, like debt, that, they were bond investors because they got paid for the use of their money. The problem when they raise interest rates like they have, Peter, from, the federal funds rate went from what, 0.25% to basically 3.5%, and we're still on that trajectory. That had a significant impact on the price of bonds that are already in circulation, because new bonds are paying more interest than the old bonds. So if you wanted to get out of your old bonds and get into new ones, you'd have to sell them at a pretty steep discount. And so 2022 is going to go down as one of the worst years for bond performance. That traditional 60-40 portfolio, 60% stocks, 40% bonds, has been a train wreck this year. Hopefully we get the fourth quarter bounce that historically comes back into play here. But, that's the impact of, a slowing economy and then rising interest rates.
Well, the New York Times cited an article, Bonds Worst Year Yet. And then Forbes made the same statement, but in the form of a question, is this the worst year ever for bonds and fixed income? Chris, how do investors deal with the more conservative side of their portfolio, the side that is supposed to soften market volatility and not lose value, losing significant value the way that it has this year? AGG, the aggregate U.S. bond index, down nearly 14%, a little more than 14% as of the recording of this program.
Yeah. And, for conservative investors that like liquidity, cash is an alternative, but you've got inflation eating away at cash. You've got bonds significantly down in value. Add on to the cost of inflation on that. You could go into, certificates of deposit at the bank. You're starting to see some rates come up there a little bit. And we do a lot of fixed rate annuities or multi-year guarantee annuities, and we're seeing those rates north of 4% now. So we've got some other types of assets that we haven't been able to use in quite some time because of bond yields significantly increasing, that we can use some of the other traditional safe investment pieces with no risk to principal, unlike what a bond does.
So we need to understand that inverse relationship, where and how that plays out in our portfolio, interest rates and the value of bonds or fixed income funds in our portfolio, a little bit like a teeter-totter. As interest rates rise, the value of our existing bonds goes down. And that's why we have seen the losses in the bond market, and conservative investors, those with the traditional asset allocation, absolutely need to understand the risks that they are taking, the costs to their money, how continuing rising interest rates and further increases could further impact that bond and fixed income portfolio. If you want an explanation and a better understanding of all of those things, because obviously informed people make better decisions, then pick up the phone and give Chris Mcintire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, I guess a silver lining on all of this is if we do have safe bank style money, we should begin to see at least a little bit more reasonable interest rate on our savings, but maybe not enough to actually match and meet inflation.
It's kind of funny how slow they are to raise their interest rates that they pay us while they loan our money out, at 6.5% for mortgages. That's a pretty good spread on from 1% to 6.5% that they're operating pretty healthy on. And, but it is what it is. It'll eventually get a little bit better. And like I said, we use a fair amount of those multi-year guarantee annuities, 2, 3, 4, and 5 years now, that we haven't been able to use in quite some time because they weren't paying much of anything, that are now, some pretty significant rates. And, you have to remember those are backed by the claims paying ability of the underlying insurance company. So you want to pick good, stable type quality companies as well, and understand, all of those, throwing my disclaimer out there anytime we talk about something like that.
Yeah, and of course, not an endorsement for any particular investment strategy or product or fund. We are just having conversations about how these rising interest rates impact different aspects of our personal finance, the market, and the economy with Chris Mcintire today on the program. But if you would like individual guidance that is available to you, that is the benefit of this program, is that you have a resource, ladies and gentlemen, that you can discuss your specifics and your planning goals with. Chris Mcintire of Mcintire Retirement Services does offer the opportunity for that complimentary review and to help you design your game plan for retirement, that written retirement plan, including the income generation component of retirement, how to make sure that you have an income that is reliable and dependable regardless of interest rate or market direction. You can give a call if you would like to set up the time for the initial discussion, the complimentary review and retirement planning strategy session, 800-868-1194. That's 800-868-1194, 800-868-1194. So Chris, we've seen it. We've been talking on the program about the losses in the market substantially over the last, really since the beginning of 2020. We've talked about the bond market, but the stock market is where a lot of the time and attention and focus has seen even more significant losses than the bond market. So the stock market really doesn't like change in direction or rising interest rates either, it seems.
Well, yeah, because the rising interest rates are going to affect, potential earnings of companies, and then that's going to drive their stock performance as well. If they're not earning as much money, or if they're forecasting lower earnings, that's going to drive their stock prices down. So this year with all the volatility, we've hit, there are some trends that happen. So there are a lot of algorithm type trade platforms that will trade on the 200-day moving average. And if the S&P 500 falls below its 200-day moving average, a lot of times that's a big sell signal across many algorithms, portfolio management. And then also with the dollar being so very strong this year, if you've got a foreign government or foreign company that owns a lot of U.S. stocks and they need to generate some money or, sell, they've got to sell at a discount with the market being volatile. And that might have to be a pretty big trade. And then they've got to convert it into their own currency. So some of these things add volatility on certain days when you see the market down 13 or 1400 points, a lot of people are like, well, who's making all these moves? And, big pension funds and, big, governments and whatnot, and big mutual funds. And a lot of portfolios trade off of moving averages. So that can sometimes explain why one day was a train wreck and the next day it bounces significantly. And, probably an important piece of information is, look, you need to be in the market to take advantage of those big days on the recovery. Sitting in cash after you can't take any more pain might not be doing you any justice. Is how, and look, we get it. It's been a tough year. Those bond portfolios are going to get better as interest rates increase. You're going to get higher rates of return, and it just doesn't happen overnight, but it takes time. So everybody who's in bonds now, you'll be eventually buying new higher rates of return. That's a bright spot in all of this.
Yeah, there are a couple silver linings. I mean, it's a bit of a chicken and the egg, which came first scenario, but because of the inflation, Social Security recipients are set to get one of their highest COLA, cost of living adjustments ever on record in 2023. The savings interest rates on savings should improve. And Chris, as you just mentioned, those newer bond funds should be generating higher, improved yields into the future. So there are some things that are good, but we certainly have seen impacts in the bond market, current valuation, in the stock market prices and volatility, because companies finance things too, as you mentioned. I mean, development, investment, expansion, infrastructure, research, those kind of things. And when it costs them money to more money to finance those kind of things, they do less of them, and those profit and forecasts, Chris, if they're not meeting those, that's seen as a bad kind of sign for the valuation. If they made those forecasts last year and because of inflation, because consumers are tightening their belts, they're not hitting those profit goals for this year, the stock price suffers. But again, kind of silver lining, they may adjust those forecasts into next year, and as conditions improve, they probably will recover. That's why some of the best years happen after some of the worst years in the stock market. You did mention pensions, and I don't want to run out of time before we get to this, because this is actually a big one. Rising interest rates can impact pensions. And on the surface, I really didn't understand this. You brought it up, and I did a little bit of research, and it does make sense here, Chris, but maybe not affecting a lot of people, but the people that this does impact, they need to pay special attention to their pension lump sum and income into the future.
Yeah, Peter, good point here. And a good thing to kind of close the show on is a lot of folks are going to get an offer on, do they want to take what they could get a monthly pension? Do they want to take that amount in a lump sum, roll it over into an IRA where it's not a taxable event until you start to make your withdrawals on it? And the amount of that lump sum pension is impacted by rising interest rates. As interest rates increase, okay, your lump sum dollar amount's going to get smaller because it takes less money to generate the income that they were going to give you in your defined benefit plan, which is a pension plan. So, what you might have gotten $600,000 on when interest rates were incredibly low, you might get $450,000 now because interest rates have come up. And I'm just giving an extreme example there. So that is a very important decision. And, we may be coaching some folks into saying, look, you probably need to stick with the monthly pension that you're getting here because you still need to generate that kind of income for most folks, unless they, are financially well off enough, they don't need to create the income stream out of it. But, that's a very important piece. As interest rates rise, those lump sum rollover amounts get smaller.
Yeah. And I know, Chris, you have talked about the type of analysis you help individuals do on a case-by-case basis to evaluate what is the best option for their pension. In researching this, after you brought it to my attention, I found an article that sort of floated the idea that retirees thinking of retirement in the near future, if they've got a pension on the table, may want to accelerate their retirement date. And I sort of chuckled at that because with the market environment in general, that may be as detrimental as it is beneficial. But I know, again, Chris, it is on a very specific case-by-case basis. So ladies and gentlemen, if this does apply to you, just something to be aware of, but something to understand and educate yourself on thoroughly in making any kind of decision. So if you would like more information and education, pick up the phone and give Chris Mcintire a call at Mcintire Retirement Services, 800-868-1194, 800-868-1194. We have talked a lot about rising interest rates, and on the surface in certain conversations, we may even hear that interest rates are improving. Rising rates, however, as detailed in many aspects on this program, do have some pretty far-reaching implications. So we need to understand that and get a better handle on what impact and continuing impacts more rate increases into the future may have on our financial investment and retirement well-being. Chris, always a pleasure having you as the resource, shedding light on important topics here on your game plan for retirement. Thank you for being here as always.
Hey, my pleasure, Peter. Thanks for listening, everybody. Have a nice weekend. Be safe out there. Thank you.
Chris is looking forward to hearing from you soon, helping in any way he can. If you would like that complimentary review, pick up the phone, give a call, 800-868-1194. That's 800-868-1194.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.